In our next chapter of Economics 101, we discuss U.S. retail sales. This number in particular is quite important because it shows at the end of the day, despite all other economic trends, the consumer has a last word. U.S. retail sales are reported on a year over year basis 4.1%. This is the best number we've seen going back to December of last year. It's actually a very good number. Now, within this number, there is uneven economic growth. U.S. retail sales are broken down in several categories. Here's what's interesting. We've spoken about in the past the inflation and the CPI versus the core CPI. What's the difference? Food and fuel. It's the weakest part of the inflation report. We'll take a look at the weakest part of the retail sales report. Food and beverage stores, gasoline station sales, that's down 3.9% from this time last year. Grocery stores only up 1.7% from this time last year. So when we look at the PPI or the CPI and we see the main number is down, that inflation is subdued because of weak food and fuel prices, well, that's translating into the US retail sales as well. Now, the largest divergence within this month's retail sales, and it's not only this month, is non-store retailers versus gasoline stations. Now, non-store retailers, we think of online shopping versus gasoline station sales. That's negative 3.9% versus 9.8% up from this time last year. We can see the overall trend. Well, the trend is quite obvious. Non-store retailers, that's in red. Gasoline station sales, that's in yellow. Now, over the long term, these two lines have diverged the most from any sector within U.S. retail sales. Both have perked to the upside in the last report, but still remain quite spread apart from each other. Now, why are retail sales so important? The consumer, at the end of the day, has the last word. We think about the chain of events that goes into making up the economy. We start with the raw materials, and these numbers are reported by the producer price index or the import price index for those goods imported from over the seas. That is then sent to the manufacturers in some cases, and those numbers are reported in prices paid. That's how much they pay for the raw materials. Prices received, that's how much they receive from the consumer. And at the end of the day, it's sent to the consumer. And those numbers are recorded as the consumer price index, or in this case, retail sales. So you see, we look at all the different components of the economy, but at the end of the day, the economy is very much dependent on the appetite of the consumer. And we can see, for example, non-store retailers up 9.8% from this time last year. Certainly, it shows the consumer has quite a bit of an appetite still, at least for this sector. And that is encouraging. However, in the past, we've seen, for example, 2008, in white, that's the S&P 500, in yellow, retail sales. And when the economy turns sour, this number turns sour as well and actually holds quite consistently with stock market trends. So when one goes down, the other tends to follow. So that's why it's so important to watch. We spoke the other day about the topic, when will the stock market stop going up? Well, this is one piece of confirmation that tells us as long as a consumer at the moment still has an appetite, there's little reason why the consumer would stop shopping, little reason for stocks would not expect higher earnings as well. As a reminder, this is part of our overall series, Economics 101. Last time we spoke about the Empire State Manufacturing Index. We hope this has been helpful. We look forward to seeing you back soon.